Our next guest says that the FDIC is looking at how to overhaul the agencies in the wrong way. He says the agency should focus on what is the most effective way to fix the credit ratings problem. He says the proposals on the table aren't the best ones out there. Here to share his ideas is Sean Egan, president and founder of Egan-Jones Ratings. Sean, it's great to have you on the show. There are a few different options on the table right now the FDIC is considering. There's a year of review before things truly change. Tell me, why do you think the FDIC is examining this in the wrong way?
Well, they've proposed a few different options which we don't think are going to be successful ultimately. In fact, the underlying premise is wrong. The FDIC has said that the ratings issued by the NRSRO firms have been inaccurate, and they have been. However, they haven't made the distinction between incentives. If a rating firm is paid by the investors, they have a completely different incentive base than if they're paid by the issuers. And the problem has been the issuer-paid ratings have been completely off. In fact, to the tune where AAA ratings were cut to D in a period of 2 days in the case of Rhinebridge and Atomo and some others. So where there's a will, there's a way. If the incentives are aligned, then you're likely to get timely, accurate ratings, which are lacking in most cases right now.
And that pay structure that you're referring to obviously is relevant to your own business model there as to how you are compensated for the ratings you give. How does this affect you?
Well, absolutely. We don't see how the conflict is manageable, and therefore we don't accept compensation from the issuers. There's a couple of different alternatives that the FDIC is looking at. One is credit spreads. The problem with that is that it's very easy to manipulate. You just buy out all the float, and all of a sudden the credit spreads compress, and you can claim that it's a much higher, much better credit than it is.
So you could manipulate the market, and then allowing the market to price risk would not be effective, you say?
Absolutely. The other alternative is a bank's own internal ratings. Those have failed exactly when you've needed them. The Black Swan author, Nassim Taleb, has written extensively on this. Basically, value at risk works very well under normal market conditions. When you really need those, the pricing goes haywire, and therefore they're not a very effective means. In fact, if you look at all the major failures, the Lehman Brothers, the Bear Stearns, the Countrywide, they had reasonable value at risk. It's just that the market didn't believe that the credit quality was there, and therefore the institutions fail. So we think that is also a flawed approach. And the last approach is the regulators coming up with their own process. Oftentimes they simply don't have the expertise. This business is tough. You have to know what you're doing. You have to be focused on it. You have to be focused on it, and we don't think that the regulators have the right skill set to implement that.